Good afternoon to you all. My name is Christy Fagbewisa, and I'm the co-host for today's webinar. I would like to thank everyone that has been here. It's very timely. We'll be starting exactly 3:05, so wait for more participants. Thank you, and God bless you. Sorry. So as I was saying, thank you for joining. But my time is 3:05 and we are starting immediately. I would like to welcome everyone once again. Bible says we should give honor to those who honor this too. So I'm welcoming Mr. Abiola Ebiemi, the tax head FCMB. Thank you for joining, sir. So today is going to be a very educating section, and I would like us to pay attention to our facilitator when she comes on board. And I have a singular honor to invite her to take up the task now. And the ground rule that we'll be having, please, if you are not talking now, we appreciate that you mute your mic so that we'll be able to minimize distractions during this section. Thank you and enjoy this section. So Obi, you are welcome on board. Can you hear me?
Yes, Christiana, thank you very much. Thanks for being my host. Please let me quickly share my slides. Please, I hope you can view the slide from your hand. Is it visible?
Yes, we can.
All right, thank you very much. So good afternoon, everyone. And thanks for participating. I'm excited to be here, and I also appreciate all participants. In light of Mr. Abiola Ebiemi, thanks for joining. I also appreciate Christiana, my co-host, and Chima. Thanks for giving me this wonderful platform for this webinar. I really appreciate. I thank you all for participating. And welcome to the training section with the theme, the impact of IFRS in financial reporting interpretations. I would like to start this class by asking a question, and I want a response from the other hand. My question is, have you ever been faced with the challenge of ensuring your company's financial statements is in line with IFRS, that is, International Financial Reporting Standard? Let me repeat it again. Have you ever, for one way or the other, faced with the challenge of ensuring that your financial statement is in line, is in compliance with IFRS? If yes, so what are the challenges and how were you able to resolve them? Sorry, I need someone to answer the question. I know we are all chartered accountants here. In one way or the other, we have come across complications in IFRS reporting and all the likes. Please, I want a practical way, the practical aspects in which you are able to overcome the application of IFRS in your financials. Please, I need someone. Chima, please, can you unmute, or they can unmute themselves? Is Chima there?
I'm here. Chima
Okay, yeah. Please, if you have a practical experience to share with us, you can raise your hand from the chat box, or you let us know. Okay, Chima. Anyone? Christy, is anybody raising his or her hand? I need someone to give me a practical. Yes. All right. I need someone to give me a practical way he or she has been able to undo his financials. I know we are not new to IFRS on this platform. I assume we are not new. Okay, yes, someone is raising his hand. Christy, are you there? Please let me unmute Mr. Ofosu. Mr. Ofosu is online. Please let me unmute him to take up the floor.
He didn't enable his mic, so he can't speak.
Sir?
Mr. Ofosu, if you can hear me, kindly enable your mic.
Mr. Fesso, are you still there? Are you having issues in unmuting yourself? Please, can anyone take up this question, please, before we proceed? It's very important for us to have a practical way of doing this. And for us to achieve this objective, we have to get a feedback before we can proceed. Please, let somebody take up this challenge, please.
Please unmute yourself. I've asked him to unmute himself. Go ahead.
Okay. All right. I hope he will do that. Okay, let's just proceed. And I'm still expecting that practical scenario from his end. So let's just proceed before. Okay, Mr. Abiola Ibiyemi is raising his hand. Mr. Abiola Ibiyemi, please kindly unmute yourself if possible from there. Mr. Abiola Ibiyemi is raising his hand.
Okay, I think the question is how the challenges faced in the process of converting from general accounting standard to FRS, right?
Yes, sir.
Okay.
Yes, sir.
I think at the I think based on CBN regulation, most banks are required to comply with IFRS. I think as far back as either 2011 or 11 or so. I'm not too sure of the year again. So the major challenges banks have to face then was to have a practical grasp of how it should be done. So most of the organization or banks have to engage they call them the first four accounting firm, the like of Deloitte, PwC, KPMG, and the likes. So it was, though it was a tough time, because even the local auditors, I mean, those staff that were on grant in those big four, it's not that they have a total grasp of the IFRS. So banks are used as a guinea pig also to learn. So as the consultants are learning, the bank officers too are learning along the line, even though they have support from their foreign partners. So as a result of big volumes of data to deal with when it comes to, especially when it comes to the issue of risk assets, where it requires judgmental methodology for classification of loans, you understand? So those software were deployed, but you know, it come at a cost, huge cost, and it was discovered that even most of those software, they were not the local environments were not properly taken into consideration. So along the line, most of the local software come on board. And if I may now summarize, the challenges is more of technical know-how, the cost, and acceptability among the stakeholders. Thank you.
All right, sir. Thank you very much, Mr. Abiola Ibiemi Ed, Tax Unit FCMB. Thanks for participating, and also thanks for the wonderful answer to the question. So thank you very much, everyone. A short story before we proceed. Once upon a time, there was a passionate event planner named Emily. Emily is all about making events extra special for clients. Before she gets into IFRS, that is the International Financial Reporting Standard, Emily will book revenue the moment the client signs an engagement, no matter when the actual event takes place. Emily will book revenue the moment a client signs an engagement with her, no matter when the actual event took place. Upon embracing the standard, that is IFRS 15 to be precise, Emily's approaches changed. And instead of recognizing revenue straight, Emily learned to identify single performance obligation. I know someone will want to ask me, what is that performance obligation I'm talking about? Performance obligation is that promise you make to your clients to deliver that goods and services. And as an entrepreneur, I know we have a lot of entrepreneurs in the house today. As an entrepreneur, that excellent service you promise your clients, that goals you promise your clients to deliver, is your performance obligation. So, upon embracing IFRS 15, she started recognizing revenue over time as a team deliver each aspect of events and customers were satisfied. So, IFRS helped her create a true picture of how well her business was doing, now showing the importance of each event in its company's finances. So, thanks to the changing power of IFRS. A quote: IFRS is not a challenge, but is an opportunity for financial leaders like you and I to display our commitment to accuracy. I repeat, IFRS is never a challenge, but is an opportunity for you and I, chartered accountants, to display our commitment to accuracy. So good afternoon, everyone. My name is Oluwatobi Okoma, a senior associate SIAO partners. Oluwatobi is a chartered accountant, and I experience course across different areas such as auditing, training, facilitating, and then throughout my career, I've been heavily involved in training professionals, and this has equipped me with a valuable skill set that I'm eager to share with you all today. With the years of experience in this field, I'm not just here to talk about standard. I'm here to share with you the practical insights on how to apply this standard in financial reports. So, Oluwatobi will be your guide for the next hours or more, and I'm excited to be here once again. A big thanks to my friend, Christy Pagbewesa and Chima for this wonderful concept. It's a massive one, and I really appreciate. And to all participants today, let us be rest assured that we are here to learn, unlearn, and relearn. So thank you very much for having me. So if you have any question, let's make use of our chat box, and you can as well raise your hands. We are not going to give access to unmute ourselves so that we can make proper and effective use of this platform. So thank you very much. Please let me confirm if my slide is changing from your hand. Are you there? Christy?
Yes, I'm here. I'm here.
All right. Please, are you recording, please? Please, let's record this.
Yes, it's on record.
All right, thank you very much. So, guiding you through this topic, we are going to cover various aspects, which includes the overview of IFRS, which is International Financial Reporting Standard, its objective, the key standard that affects financial statements, then introduction and components of IFRS 15, which will be dealt with in details today. Then at the end of the section, we are going to be having a practical question using MTN and Julius Berger construction as a case study. So let's kickstart the training. Please let me confirm if my slide is changing from over there.
Yes, it is.
Okay, all right. So let's quickly talk about the objective. Let's talk about the overview of IFRS. Let's go back. The overview of IFRS. The overview of IFRS. International Financial Reporting Standard is a set of accounting standard that is developed and maintained by International Accounting Standard Board, that is IASB. IFRS is based on a set of principles other than the usual GAAP, that is the US GAAP. And this is to allow us to be able to have a flexibility and transparency in financial reporting. So one of the objectives of IFRS is to create transparency and flexibility in financial reporting. So some of the countries make use of this principle mandatorily for companies, especially the public quoted companies. So this set of standards covering various aspects of financial reports, which includes the recognition, the measurements, the presentation, and also disclosure of financial information. So example of this key standard includes IFRS 9, which is financial instruments, IFRS 15, which is revenue from contracts with customers, and we have IFRS 16, which is leases. So let's talk about the objective of IFRS. The objective of IFRS. The objective of IFRS. Number one is global standardization. Global standardization, that is uniformity. IFRS will aim to create one set of excellent accounts that can be used worldwide. And this is just to ensure that companies are able to compare their performance and also benchmark their performance. Because when there is a single rule, when there is a single standard, it's easier to benchmark. And it's also of advantage for the stakeholder, for the investors. Investors will be able to see which company is doing well because they have the same standard. They are based on the same standard. So it's very easy for them to be able to know, this is where to invest my fund. And this is one of the objective of IFRS. Number two is transparency and disclosure. Clarity. This means given a clear and detailed information about how well a company is doing financially. You know, when there is financial transparency, it also enables the stakeholder to know how well the company they invested in is doing. Because everything is being stated, is clearly stated. So let's go to the next objective, which is relevancy and reliability. That is important and correct. Important information helps stakeholders to make smart decisions. important information help stakeholder, the users of financial statements, to make smart decisions. Why correctness means the information is free from mistakes and error. It shows exactly what is going on in the company. Relevancy and reliability. So let's move to the next objective, which is facilitating capital allocation. When a financial statement is transparent, is free from error, is reliable, is globally accepted. So for stakeholders to invest their fund will be very easy. So it enables the stakeholder to be able to pinpoint, this is where I want to invest my money. I'm not investing my money here because all the other criteria have been met. So these are the 4 important objectives of IFRS. So let's go to the key challenges. Let's go to the key challenges. When there is advantage, there surely be a disadvantage. As Mr. Abiola said from the introduction, said there's a lot of complexity. Yes, there is. So from the challenges, here we have complexity of the standard. Complexity of the standard. The rule of IFRS can be really complicated, really. And it needs a good understanding of accounting. So for you to make sure you follow up with this principle, you have to have a knowledge of accounting. And it's most complicated in the aspect of those companies that have a complicated processes. Some industries, their transactions are so tricky. Even for you to be able to recognize revenue is another thing, and not to apply the standard is another thing. So complexity of operations is what is in here. So the standard is so complex for it to be applied. So let's go to the next one, data quality and integration. Sourcing of data that will be in compliance with this standard. Data sourcing. In some companies, there is a lot of issues there, most especially for companies that have different branches. Companies that have different branches in all locations. For them to source data to comply with this IFRS is a problem. So this is one of the disadvantage of the standard. Let's look at the impact on IT system. I know different companies have their own system, IT system. You know, IFRS is on update. You have to update your system to be in compliance. And sometimes for you updating your system that meets with the standard of IFRS, it can be complicated. It can even interrupt the other information in the system. So some systems are easily to be corrupted when it is updated. So this is one of the challenges in which is attached to IFRS. So let's look at resource constraint. The resource constraint. Having enough money or people to follow this rule, this principle. Let's look at the SMEs and the SMEs and medium scale enterprise. Most of them are struggling. So for them to be able to have the fund to get an expert in conversion from their own regular rules accounting to IFRS can be difficult. Resource constraint. Training of staff involves fund. And most of the scales, the medium scales and the small scales cannot afford it. Cannot afford to train their staff in compliance with the standard. There is no fund to source for expertise. So these are one of the major constraints in applying the standard. So let's look at the last one, which is the transition challenges. That is, switching from local GAAP to IFRS can be difficult most times too. Yes, for companies that have a complicated accounting rules in place. And also it needs teamwork and also expertise too. So these are the challenges in which is faced in order for companies to apply IFRS. Hope I'm communicating. So if I'm communicating, please just chat hi in the chat box. Let me see. Let me know. Let me have a feedback that I'm communicating, please. I need a feedback from the chat box. let's go ahead. Feedback from the stakeholder on IFRS knowledge and application. This is a feedback from the stakeholder on how IFRS is being known and applied. It is observed that 10% of the stakeholder have no knowledge of what IFRS is all about. In fact, someone called me 2 days ago that told me there's a mistake in your flyer. I said, what's the mistake? He said, you're supposed to write FRS. You're writing IFRS. I said, no, it is not IFRS. It is not FRS. It is International Financial Reporting Standard, not Federal Inland Revenue Service. Say, okay, that I thought there's a mistake there. So there are some set of people that don't even have idea of what IFRS is all about. And this set of people falls into the 10% of the stakeholders. So let's look at the 70%, which are the basic knowledge of what IFRS is all about. Those are the practical stakeholder, the theoretical stakeholder. Those are those set of people, the ICAR student. They can write everything about the standard. They are good in theory, fantastic in theory, but the application is the issue. So those set of people fall into the 70% of the stakeholder. So the last one is the advanced knowledge. Those are the set of people that know it theoretically and also apply it in practical life. So let's go ahead. Let's look at the components of financial statements. The components of financial statements. We can talk about IFRS without not talking about the financial statement itself, because we are applying the standard into financial statements. So what are the components of financial statement? Number one is the balance sheet, which is the statement of financial position. Our statement of financial position shows what the company owns, which is the assets, then what is owned by the company to the stakeholder, which is the liability side, and also what is left over for the shareholders, for the owners of the business, which is what? The equity. So the statement of financial position comprises of what? The balance sheet, which comprises of the assets, the liability, and the equity. So let's quickly move to the income statements. The income statement shows how much the company is generating. How did they generate their fund? We'll talk about the revenue. Then how did they spend their fund? And that one talks about the expenses. Now, the revenue expenses now resulted into net loss or income. So it will show whether it ended up to be an income, and it shows whether it ended up to be a loss. So we have the net income or loss. So let's go to the next slide, which is the components of financial statement. That is the statement of cash flow. The statement of cash flow. The statement of cash flow separates cash inflow and cash outflow, different from activities. So it comprises of the operating, that is where the sales and the services have been generated, the operations, and also talks about the investment activities. That is the buying of equipment and properties of the company. Then we have the last one, which is the financial activities. This is acquiring of assets and also repayment of debts and all the like. So the last one is the statement of equity. The statement of equity. Under the statement of equity, we have the transaction with shareholders, such as in their issuing of and buying back of shares. And then we have the changes in profits, the company's profits, that is where the changes in company's profits kept, which is what they retain earnings. Hope I'm communicating. Hope I'm communicating. Okay, someone have a question. Yes, I have seen you. Let me just complete this. Then we have a space for questions and answer, please. So let's quickly talk about the key standards that affect financial statements. The key standards that affect the financial statements. The key standards that affect the financial statements. Number one, we have the IFRS 10. The IFRS 10, which provides guidelines on consolidation of what? Of financial statement. Then we have IFRS 16, which addresses and recognizes and also the measurement of leases. Under the income statements, we have IAS 1, that is presentation of financial statements. Then we have IFRS 15, which talk about the recognition, measurements, disclosure of revenue from contracts with customer. And in the course of this training today, we are going to deal with this standard in details, that is IFRS 15, revenue from contracts with customer. So let's go ahead. Then we have from cash flow statements. The cash flow statement talks about the regular IAS 7, which talk about the cash flow from operating, investing, financing activities. And we have IFRS 9, which talk about the classification and measurement of cash flow related to what? To financial statements. By His grace, we are going to be looking at each of these key standards, one after the other in our forthcoming trainings. But today we are going to emphasize on the revenue from contracts with customer. So let's quickly talk about the statement of equity, which is also affected by IAS 1, presentation of financial statements. We have IFRS 9, financial instruments. And then this standard ensures transparency in all the disclosure and changes in what? In equity. So why the notes to the account encompass all the standards? The note to the account takes all the standard because this notes provide additional information and explanation about other standards in the financial statements. So such as the accounting policy used, the assumptions, the contingents, and every other information that gives the users a clearer view of what financial statements is all about. I hope this is gotten, hope we are clear about this. Please, let's quickly go to the next slide. Hope my slide is changing, Christy, so that I will be on the same page. Christy, are you there? Please, I need a feedback.
Yes.
All right,
Yes,
thank
please.
you. All right, thank you.
All right.
So from all the standards, we are going to be talking about IFRS 15. When we discuss revenue, we are looking into the most critical elements of financial statements because that is where funds are generated. It's the lifeblood of any business whatsoever. And shareholders are always interested on how revenue is being generated, how it can be enhanced, and what are the expenses that is drawing this revenue back? What are the impacts? What are the expenses that is impacting on the growth of this revenue? They want to know about it. And that is the reason why we are taking this hub today to in-depthly analyze what the standard is all about, IFRS 15, revenue from contracts with customer. So let's go ahead. Yes, I'm seeing some hands. We are going to ask questions. Let us finish with this slide, plus. All right, let's quickly talk about the overview of IFRS 15. The overview of IFRS 15. In the era of IAS 18, we know that's the former standard which is being replaced. In the era of IAS 18, so revenue recognition demonstrates several challenges. So such as complexity in accounting, contract accounting, inadequacy in guidance, most especially for service and other revenue, difficulty in recognizing revenue from other services. We also have the limitation of disclosure, inconsistency in revenue recognition practices as well. So, to clear all this confusion, the International Accounting Standard Board collaborated with the Financial Accounting Standard Board to base a new standard. That is, the International Financial Reporting Standard 15, commonly known as IFRS 15, revenue from contracts with customer, effectively on and after 1st January 2018, mandatorily. And from that day, all previous standards were suspended. So let's quickly look at the scope and exemptions to IFRS 15. What are the scopes and exemptions to IFRS 15? IFRS 15 applies to all contracts with customers with some exemptions. So what are the exemptions? Number one, non-monetary exchange between entities in the same line of business are excluded from this standard. What does that mean? That's non-monetary exchange between entities in the same line of business. When we talk of barter trading between entities in the same line of business, barter trading between two companies in the same line of business, just such as Coca-Cola and Pepsi. So this standard is exempted from them. So let's look at the second one, which is certain non-monetary transaction. Certain non-monetary transaction. Transactions that are not in exchange for consideration. Transactions that are not in exchange for cash, such as donations, contributions. When we talk of NGOs, they're based on donations. So they are automatically exempted from IFRS because they're based on donations. They are not selling anything. So not certain monetary transaction is what is exempted from IFRS 15. And the third one is financial instruments and other standards. That is, contract that falls within scopes of other standards, such as IAS 39 or IFRS 9, which is for financial instruments, IFRS 16, leases, and what are exempted from this standard. So let's go ahead. Let's go ahead. So the most important thing that IFRS 15 does is to introduce the 5-step model for recognizing revenue. The most thing IFRS 15 does is to recognize the 5-step model in recognizing revenue. So what are these 5-step model? All the slide is changing. Christy?
Yes, please. Yes,
All right.
yes.
All right, thank you. So the 5-step model, number one is to identify the contract with customer. Number two is to identify the performance obligation in the contract. Number three is to determine the transaction price. Number four is to allocate the transaction price to the performance obligation, while the 5-step is what? To recognize revenue when and as the entity satisfies performance obligation. So, if you want to determine how and when to account for revenue in your particular company, in your transaction, the operations you are working with, your company, all you need to do is to walk through this 5-step model. There is no how complicated your organization is. So far you can identify this 5-step model, you will be able to recognize revenue according to IFRS 15. So let's take a brief look at each standard of IFRS 15. Number one is to identify the contract with customer. The first step is to identify the contract with customer. Before you can identify the contract, you're supposed to know what the contract is. You need to know what you're identifying, which is a contract. So what is a contract? Christy, please, I need someone to respond to that before I proceed. What is the contract we are identifying from the first step of the fifth step model of IFRS 15? Please, I want someone to say something, Christy. What is a contract? The first step is to identify the contract with customer. So what is that contract we are identifying? I need someone to define what contract is to me. Is anybody raising his or her hand? I'm not saying this.
Yes, we have one hand up. Oluseyi Adeniji.
All right. Please, let's unmute ourselves. Please unmute yourself. I'm not saying. Okay, yes.
Okay, good afternoon.
Yeah, good afternoon, sir.
Good afternoon. Am I good enough? Do you hear me?
Yes, we can hear you. I can hear you from here.
Okay. Thank you for the great job you are doing. Okay. So, simply put, a contract is an agreement, right, between two or more parties to perform a particular obligations within a period of time. Just an agreement or a contract is an agreement between two or more parties. With one or the other parties having responsibility to perform a particular obligation, to carry out a task or an activity within a stipulated period of time.
All right, thank you. Do we have any other contribution to that? Thank you very much, Mr. Oluseyi, for your contribution. Do we have any other person that want to contribute to that before we continue our training? All right, let's just go ahead.
Sorry, Toby.
Yes.
Somebody already raised hands.
Okay,
Some
please.
minutes ago, Olasoji Adeoye.
Okay.
I wish to call on for some contribution. Thank you.
Please unmute yourself so that you can have the floor.
Mr. Olasoji Adeoye, you have the floor now.
Okay,
I think it's no longer here.
all right. Thank you. Let's continue. All right, thank you. So we have to identify the contract with customer. As Mr. Oluseyi has said contract is between two or more people. Yes, according to IFRS 15, a contract is a certain agreement that creates an enforceable right and obligation, just as it is on my slide. Hope everybody can view the slide. It is a certain agreement that creates an enforceable rights and obligation. So we have two types of contracts. A contract can be in written form and it can be oral. Yes, it can be in written form and it can be oral. For me going into a shop to get some items and for the seller giving me the goods, and me paying the seller is what? Is a contract, but it's not written. It's an oral contract. So a contract can be in written form and it can be oral. Someone is raising hands. Maybe we should take that before we proceed. Mr. Obi, do you have anything to say concerning the contract we are into now? Okay, please, let's go ahead.
Yes, I can unmute myself now.
All right.
think you said that your slide is not moving again. No?
It's not moving. Christy, please let me confirm that. Identify the contract with customer. That is the slides we are in here.
Yes.
The same.
Yes, we are there, but you have gone past that place now. It didn't move.
We are still
She's on
explaining
contract
contract
modification.
with customer. We are still in first step. And that is what we are explaining.
Okay.
All right, thank you, sir. So contracts can be in written form and it can be oral. We have a combination of contracts and what? Contract modification. What do I mean a combination of contracts? You are getting different things at different time. You are getting different things at the same time, sorry. You are getting different things at the same time. That is what combination of contracts. And when you have a combination of contract in any organization or processes, IFRS 15 permits that this contract can be treated as one. This contract can be treated as one in order to what? To remove the complexity. Number two of it is contract modification. That is adjusting the existing contracts. Means making changes to what? To the existing contract. So this modification can also create complexity in revenue recognition as well. Yes. So under IFRS 15, which offers the guideline on handling contract modification. So there is 3 options being given. Number 1 option is that that modification can be treated as a new contract, or you modify the existing contracts, or you can use both approach. That is, that modification of contracts can be what? Can be treated as a new contract. You can also go ahead and adjust the existing one, which is 2. And number 3, you can use both approach. You can see how flexible this standard is. So there is no restriction anywhere. So we have talked about the contracts with customer. We said contract is a certain agreement that creates an enforceable rights and obligation. They are of 2 types. We have the written contract, we have the oral one. Then contract is of 2 types. We have combination of contracts, which can be treated as one according to IFRS 15. And we have contract modification. Under contract modification, you can treat the modification as what? As a new contract. You can also adjust the previous contract or use both approach. So let's go ahead to the next step. Hope that is taken. So the next step of the 5th step model is identify the performance obligation in the contract. You know, we are able to identify the contract now. Yes, everybody can identify contract now. Yes, it's a certain agreement between 2 people that brings the rights and obligation. Everybody can identify. Now, the second step is to identify the performance obligation in that same contract. What is performance obligation? As I've said earlier in my introduction, the performance obligation is that promise you made to your clients. Is that good services? Is that goods? That excellent service you promise your clients? That goods and services you deliver is your performance obligation. So performance obligation can be a distinct goods and services. It can also be a series of distinct goods and services. So when a performance obligation is a distinct goods and services, that is, it can be a standalone. That is, the obligation can be a standalone, not a consistent one. And the second type is the series, that is connection, collation of goods and services, requesting for multiple things. Please note that if there is no transfer of goods and services, there is no performance obligation. If you are not transferring anything to your customer, there's no exchange of rights and obligation, then there is no performance obligation. just as an example of an NGO that generate their revenue through donations. So there is no give and take here. Is a donation, is a gift. So in that kind of scenario, there is no performance obligation. So they are exempted from IFRS 15. So let's go ahead. Hope that is taken. Performance obligation is that promise you made to your client to deliver that goods and services. And we said it's of two types. We have distinct goods and services and series of distinct goods and services. Distinct goods and services is a standalone performance obligation, while the series of distinct goods and services are the connection of performance obligation. So let's go ahead. The third step is to determine the transaction price. The third step is to determine the transaction price. So what is transaction price? What is transaction price? Transaction price is the expected amount of consideration that an entity has the right to receive under the contract for delivering that goods and services. That is, the fund you are given for exchange of that goods and services is what is your transaction price. According to IFRS 15, transaction price can be fixed and it can be variable. So when it is fixed, you are paying the exact price for that obligation. You are paying the exact price for that obligation. So when it varies, it shows that it can be a discount, it can be a rebate. It can also be meeting a deadline, or you just like the face of the buyer. No, I just love your face, so I'm discounting you. You're supposed to pay 10 naira, so pay 5 naira because I like your face. So this constitutes varying of transaction price. So transaction price is what? Is that consideration you receive for what? For the exchange of that goods and services. And note here too, that if transaction price involves non-cash items like goods and services instead of cash, so this item needs to be included in what? In the overall value of the transaction. Based on what? On their fair value. And that is where IFRS 13, which covers fair value measurements, comes in place. So in this situation of transaction involving non-cash items, IFRS 13 expressly stated that an item should accurately be determined by its fair value and add to what? To the overall value of the transaction. So this is just to enable the financial position to reflect the economic substance of transaction in financial statement. Hope that is taken. Hope that is taken. All right. So let's quickly proceed to the next one. This is a kind of a practical aspect of it. I will need a feedback from you from here. This is a typical scenario which we are using to allocate the transaction price to performance obligation. We are able to identify the contract with customer. Then we can also identify the performance obligation, fine. Then we also determine the transaction price. We said it's the consideration, right? Now, we have to allocate the transaction price to what? To performance obligation. So this leads us to the 5th step model of the 5-step model of IFRS 15. Now, this is a scenario. I like shoes a lot. Yes, I love shoes. And one day I saw a fantastic deal at our favorite store. There was a special promo going home that if you buy a pair of shoes, you get a free socks. Hope my slide is showing the 4th step model. Christy, please let me confirm that. Christy, please, are you there? Please, can anyone confirm to me that we are on the same page?
I'm here. I'm having network-related issue.
Okay. Please, what is the slide? Yes. I have with me here the allocation of transaction price to performance obligation. Hope that is what you're having from your hand. Please confirm. I want us to be on the same page so that we can have a proper view of this scenario. I need someone to confirm before I proceed.
Please, we may wish to continue. Allocate the transaction price to the performance of the
Okay, that's fine. That's fine. Thank you. Thank you.
Continue.
All right, thank you. So I saw this fantastic deal that if you buy a shoe of 100,000, you are going to have a free socks. So you know it's a deal. Anybody is a promo. So everybody bought into it. I also bought into it. So when I got there, I saw the seller. This is what is open. So from this scenario, from what I just pasted now, I will need someone to help me identify the contract with customer number one. From the same scenario, you identify the performance obligation too. And from the same scenario, the transaction price, before we go into the allocation of the transaction price performance obligation. Please, I need somebody to do that for me quickly before we proceed. From this scenario, I have the fantastic day, buy a shoe for 100,000 and get one free sauce. From there, I want this the first three-step model should be identified. Please, is anyone taking this home? Because this can be applied in all organizations. If you are able to apply this, then you can apply it in your own operations too. Someone is raising hand. Oluseyi Adeniji. Christy, please let me unmute Oluseyi Adeniji. He's raising his hand. Ayo, Christy, you're having network issue. It's Chima. Okay.
It's done. I've done it. You can hear. You can hear.
All right. Thank you very much. Thank you.
Yes, hello. Can you hear me?
Yes, we can hear you.
All
Please,
right. From what has been said so far, identifying the first three stages from what you have said, the contract is supply or purchase of a shoe that has an addition, a free pair of socks coming with it. That's the contract. A shoe and a free post. It's a combined deal. That when I buy a shoe, I get a pair of socks free. So the contract is supply of a shoe and a pair of socks. So they are combined. So and the price. Number two is to determine the contract price. The contract price is 100. So of course you don't have to pay for the socks separately. The condition for getting the socks is that you buy the shoe, you pay for it. So the contract price is 100,000. I don't know whether I'll be able to.
Okay. All right. Thank you very much, sir. Thank you for the contribution. Any other person to also try to attend to this question, please? I need any other person to do that before we proceed. Thank you very much, Mr. Obi. You can put your hands down so that we can identify other participants. Thank you very much. All right. Do we have any other person? Okay. Think. Okay, we don't have any other more hands raised. Let's just continue. Thank you, Mr. Obi. You have really tried. Yes, from this scenario, we are able to identify the contract with customers. So what is the contract we identify here? The contract is what? The purchasing of what? The shoe to get a free source. That is the contract between.
Please, you can unmute yourself.
Okay. Am I muted? I'm not muted.
Obi.
You see, hello? Am I heard? Quissy? I'm not muted. I'm not muted. No.
I can hear you, Toby. Somebody raised his hand.
Okay, raise hand. Okay, please, let's go ahead. Okay, so who is raising hand, please, so that we can continue? You still have a practical question to solve before we end this program. Oh. Okay, I think we should continue. Yes, let's continue, please. So, the contract from this scenario is the purchase of shoes to get a free shoes. That is the contract. That is the deal between me and the seller. I want the shoes and I want the shoe, then I'll pay you. The number two aspect of it is the performance obligation. So what is the performance obligation here? We said performance obligation is that promise you made to your client to give the goods and services. So what is the goods here we are talking about? The goods is what? The shoe and the socks. So what is the consideration here? Is the 100,000 naira I'm paying to get the shoe and the free socks. So you can see that it's easy to identify the three-step model from this scenario. And this is how you are going to apply it to your what? To your transaction, your day-to-day transaction. That your complicated operations, that's how you are going to analyze them. You first determine, you identify the contract, then the performance obligation, then the transaction price. So let's go ahead. So from this scenario now, how am I going to apply the fifth step model here? That is, allocate the transaction price to the performance obligation. I need another person to tell me how am I going to allocate the transaction price to performance obligation. We have identified the first three steps, right? So now the fifth step. The fourth step says allocate the transaction price to performance obligation. So I need another person to tell me how we are going to allocate this transaction price to performance obligation. I need another person to assist in that. Yes, I have Kikelomo. Yes, Kikelomo Adeosun is here. Christy, please let me unmute Kikelomo, please. Christy, are you there, please? Please let me
I'm doing that. I'm doing that. I'm
All
having
right,
with my
thank you.
system. I'm doing it.
Thank you.
Okay.
Please, Keloma, go ahead.
Okay. Good afternoon. Hello, good afternoon.
Good afternoon, ma. Yeah.
Okay. To allocate the transaction price to the performance obligation, once the seller has been able to deliver the item, that is, the part of the obligation is committed to the buyer, then the transaction price can be taken, for my understanding, because it is when it is delivered to the buyer that you can now allocate the transaction price. Thank you.
All right. Thank you very much for that wonderful contribution. Thank you very much, ma. Do you have any other person to try? Please, I need one more person. Let's have another idea of how to deal with this step, allocation of transaction price to performance obligation. I need one more person to assist, please. I need one more suggestion. All right, let's go ahead. Thank you very much, Madam Kikelomo. To allocate the okay, we have somebody.
Please, Toby, we have one more hand up.
Okay,
Please
okay.
just hold on. Mr. Victor, you have the floor.
Okay, thank you very much. Yeah, on the first step now, what we now need to do is now to allocate the price. Having met the first three conditions, this condition, because there are two items involved, the shoe and the socks. You know, naturally we purchase the socks, so there's a cost for that socks. So now, when we are passing the entries, we need to now determine out of that 100,000, what is the portion for the socks and what is the portion for the
We can't hear
shoe.
you.
I said Where did you lose me, please? Can you hear me now?
Yes, loud and
Hello.
clear.
Okay.
Yes, we can hear you. Go ahead.
Okay. I said that since we have two goods now, which is the socks and the shoe, what we now need to do is that because the socks it's not for free, even though we say buy is a promo, buy one get buy shoe get socks free. The socks we must have had costs that we incurred in the purchase of the cost. So and that must have been factored into that 100,000. So it's now to be determined, maybe based on percentage or whatever. What is the amount that is to be allocated to that stocks to determine our cost of sales for that? We now charge it, and then also for the shoe, we know the cost for the purchase of the shoe, we know the cost for the purchase of the socks. So that's how we recognize revenue also for the socks and for the revenue. So it's now will be that 100,000 will be apportioned on that basis. Thank you.
All right. Thank you very much, Mr. Victor. You have done justice to the answer, to the question, rather. So to allocate the transaction price to performance obligation, yes, we are able to identify the first three-step model. Now, how are we going to allocate the transaction price to performance? As he has said, we are going to determine what the standalone price for the socks and the shoe. In the normal course of business, we look at how much is the shoe sold and how much is the socks separately. So we need to know and identify what their standalone price. And based on the scenario, the shoe ordinarily goes for 100,000, while the socks goes for what? 5,000. Because performance obligation here, they are two. We can't just allocate 100,000 naira for socks, for shoe, and nothing for socks. Because what? They are different performance obligation. So we won't say because it's shoe I'm buying, we are going to neglect the socks. Because socks is being purchased too. It has a fixed cost. There is a cost of purchase on it. So we need to now allocate them based on what? On their standalone price. So that takes us to the next line here, which is allocated transaction price. You know, we have already determined the standalone price, which is 100,000 naira for socks, for shoe, and for socks is 5,000 naira, which gives us what? The total price of 105,000 naira. So this 105,000, we are going to base it on what? On the transaction price being paid to allocate for each performance obligation. So by doing that, we have the 100,000 divided by what? That's the 100,000 for standalone price divided by 105,000, which is the standalone price, times my consideration, which is 100,000. From this calculation, we can now get that shoe goes for what? 95,000 naira. And we do the same for the socks. The standalone price is what? 5,000 based on the total standalone of what? 105,000 on my whole consideration price to get what? 5,000 naira. So in addition, we still have our own 100,000 naira at the end of the transaction. So this is how to allocate transaction price to performance obligation. All performance obligation has their own value, irrespective of fee. At the back end, there is cost attached to it. So we allocate based on the standalone price. Hope this is gotten. Hope it's clear enough. All right. So this leads me to the next step of the fifth-step model. Sorry, you have your hands raised.
I have a question.
Toby, somebody has a question.
Yes.
Will be at, well, okay, let's go ahead.
I have a problem understanding how we determine the price of the socks. Remember, for an accountant to make an entry, there must be a source document.
Okay.
There is where we buy these shoes. Even in the invoice, they did not indicate the price of the socks.
Okay.
So we're going to just manufacture the price and say that since we know it must cost something, we just manufacture the price. If the auditor comes to say, this socks you price at 5,000, let me see the invoice, let me see the source document. What do you do?
Thank you. From the accounting aspect, you are the owner of this account.
Mm.
You know the price of the socks. You know how much you purchase it before you take it for free, right?
Yeah.
So you know the price of this socks before you make it free. So when you are accounting for this
No, I am
transaction,
talking from the point of view of the purchaser.
we are looking at how revenue is being recognized in the aspect of the seller now.
Okay. From the point of
seller,
view.
not the purchaser. How are you going to record your own account? How are you going to treat? Then the cost of in the other aspect, that one is another part. But in your own books, how are you going to record it?
Okay, I can see.
All right. Hope is taken. Thank
Yes.
you very much. Please, all questions should be chatted in. Let's make use of our chat box for all questions so that we can make use of our time, please. All right, thank you very much for that. So we are able to allocate the transaction price to performance obligation. Now, that will lead us to the last step model of the fifth step model of IFRS 15, which is recognize revenue when, as the entity certifies performance obligation. Hope we're on the same page, please. Recognize revenue when and as the entity certify the performance obligation. So let's now take, we are still using the same scenario. Let's now assume that this promo was done as at 31st December of that year. Because we are trying to push out all our goods so that we have a fresh goods come next year. So we are assuming now that that promo was done as at 31st December. Now, I have paid for this shoe and the free sauce. Eventually, I was given only shoe. I was told to come back the next day for the socks because they've already run out of the socks. There is no socks again. They've already sold everything has been given out for free. So I was told to come back the next day for that socks. So in our books, in their books, how are they going to record that transaction as at 31st December of that same year? That leads us what to the fifth step model of the five-step model of what IFRS 15, which says we have to recognize revenue over time or at points in time. Over time or at points in time. When we say at points in time, that is, as I'm paying for that shoe and getting the free sauce, everything is completed. I've been given the sauce and the shoe at the same time, and I paid. That is at point in time, everything has been settled. So I recognize my revenue. The seller recognizes revenue, straightforward. But when we talk of overtime, based on completion and satisfaction. When we talk of overtime, it's based on the satisfaction of the goods and services as it is. Recognize revenue when and as the entity satisfy performance obligation. So who is going to assist me here to how I'm going to record my transaction? What are the accounting entries I'm going to pass as at 31st December of that year? I need someone to say something before we proceed. Is anybody assisting us for the accounting entry to pass as at 31st December of that year? We are not, okay, we have Madam Kikelomotu. Thank you very much. What are the entries to pass as at 31st December of that same year?
Okay.
All right,
Thank
ma'am.
you, madam.
Yes.
For the entry to be passed, as for at first, the other one will have been N. That of delivery of the shoe will have been N. And
Yes.
at that moment, it's only the on N revenue
Mhm.
to look at it, which is for the socks. The entries will need to be passed because it's still like standing like a liability on the seller.
Yes. Yes.
So I look at it is an on-hand income, although it's still going to maybe I don't really know. I don't really know,
Thank you
but I
very
know
much.
it's on earn income. Thank you.
Thank you very much, madam. Thank you. You really
You're
tried. Thank you. All right. Yes, as you have said, the socks costs, the socks price have not been what? Been earned as at that 31st December of that same year. I'm only satisfied with the shoe. I've not been given the socks. So it's still a liability in their books. So only shoe will be recognized as at 31st December of that year. Why the source cost will go to what? Contract liability. Let's look at the accounting entries. Hope my slide is changing. Accounting entry for at point in time recognition of revenue under IFRS 15. When we talk about point in time, they have satisfied my obligation, which is they've given me the socks and the shoe at the same time. So I've gotten it, it can be a cash, I can give them cash, or what, but I can do a transfer. So the bank is being debited, this to reflect the revenue recognized for the sales of the goods. And what, we credit revenue at the same time. So being sales of shoes for 95,000 and what, socks for 5,000. Hope this is cleared. This is for at point in time. That is, as I'm paying, I'm receiving both the shoe and the socks. No discounts, no rebates, nothing. So let's look at overtime accounting entries. So when we talk of overtime recognition, this is where most companies are having issues. This is where most companies are having issues. How do you recognize revenue over time? Number one, we see to the debiting of the cash. Since you have received the fund, is either is a cash or is a transfer, which is bank. You debit your cash with that 100,000. Only 95,000 should be what? Recognized as revenue as at 31st of that year. Why? The other leg for 5,000 is what? It goes into credit liability. You can see, being performance obligation not satisfied. So, when the performance obligation is now fulfilled, I've gotten the socks, I like the socks, is my size, then they can now recognize their revenue by debiting the contract liability or the VAT credits with what? With that 5,000 and what? Crediting revenue. So this is where the issue, the complexity comes in recognizing revenue in complex organization, in complex operations. Please, we just need to comply with IFRS because compliance is very key. Let's try to identify this. We are still going to get to some application that should be used in recognizing revenue for large volumes of transactions. So let's quickly go ahead here. We have a real life samples using MTN and Julius Berger Construction Company. Christy, please. Christy, please, are you there? Please help us share the question, please. That's the question on the real life question on MTN and Julius Berger Construction. We are using these two company because of their complexity in recognizing revenue. And we are going to apply it the way the standard is being applied in this concept.
Please, Toby, give me some moment.
No problem. Let me see if I can share. Thank you very much. So in that's your complaint, you have to picture it as by recognizing this 5-step model in the complicated transactions you have, just look at it. How can I identify this 5-step model? And from there, to recognize revenue will be very easy according to the standard. Please, we are trying to share the practical questions so that everybody can have it. There's a moment.
Please stop sharing so that I can share from here. Thank you.
Okay. Or can you drop it in the chat box?
Okay.
Please drop it so that we can still make use of the slides.
All right, that's okay.
Okay, thank you very much.
Dropping it. A moment.
All right.
I can only share with the host, not with all.
Me. Okay, okay, maybe we should do it this way.
I'll share with you. So I can't see. Let me use my phone to do that. A moment, please.
Maybe I can share from here. Okay. I think
Here
I've
we are.
shared.
Here we
Okay, you
go.
have shared too. Yes, I've also
Yes,
shared
please.
from here. Okay. Hope we
Here we
can
go.
get this. Hope we all have this. Hope we can view it. Okay. So we have from the question-based sense, hope we are able to open it from our hands. We have a practical question from Julius Berger and the MTN complaint. The first one is we are going to identify the contract with customer from this scenario pasted here. Please, I want a response if you have gotten it. Let's just say I in our chat box so that we'll be on the same page. If you are able to open and we can access it so that we'll be on the same page. Let's say I. I've not gotten any high here. Okay, yes, okay. Thank you very much. I've gotten 2. So it shows everybody can access it. Okay, please, let's go ahead because of our time. From the illustration here, we have illustration 1, identifying the contract with customer. MTA enter into a contract with ABC Venture to provide data service on monthly basis. After 5 months, ABC Venture decided to engage MTA in an additional contract for a subscription to voice call services through the use of CUG to enable undistorted communication within the organization. Required 1. What is considered as a contract with customer from this scenario? Please, I will need response from us. We have already analyzed what a contract is from our slide. We know what a contract is. We are now asking from MTN operation, everybody knows how MTN operates. Is a popular entity, and that's the reason why we are using it as what? As a case study. So from this scenario, I want somebody to tell me what are the contracts with customer from this scenario. What are the contracts with customer? What are the contracts with customers? Please, I need someone to identify. Are we all on the same page? Maybe I should read it once more. I know we have it already. MTN enter into a contract. Hello? Okay.
We have a hand up.
All right.
The contract here are two. The first one to provide data services, and the second one is to provide voice call services.
Yes, thank you very much, sir. Thank you very much, sir. That is it. Hope you are still seeing my slide. For MTN, the initial contract to provide what data services on monthly basis. And the second one is what? The subsequent subscription to what? To voice call services. That is what the contract we identify. And we have already fulfilled what? The first step from the fifth step model of what? Recognizing revenue. Let's quickly go to the next question. So what are the multiple contracts and contract modification made from this scenario? We have of two types of contracts, right? We have multiple contracts and what? Contract modification under the first step model. So what are the multiple contracts here, and how are we going to say the contract is being modified? Please, I need a reply from the participant, please.
Toby, your screen is not showing again.
It's not showing.
Yes, please.
Okay, please let me reshare. Okay. Hope you can see it now. Chrissy, can you view it now? Can you view? Please, can someone confirm to me that my slide is visible? Is it? It's visible, right? Okay, is it fine? All right, someone is raising hands. Let's just take that. Let's take that. Sorry, Christy, you're having network issue. Shema, please, can you assist us? Shema is not there.
Hello, we can see your slide.
Okay, that's fine. So, Obi, please unmute yourself and answer the second questions, please. What are the multiple contracts and contract modification from this scenario? Okay, I will need to answer her. Please, yes, Atoyebi, please, you can unmute yourself if possible. Let's hear from you. Christy, I think people need to be unmuted. Okay, you can go ahead, please.
Hello, good afternoon.
Yes, good afternoon, sir.
Yes, the contract was initially to, was initially to provide data services on a monthly basis.
Mm-hmm.
But after 5 months, at the 6th month, there's another introduction of another contract for subscription, for a contract for a subscription to voice call services. So the multiple contracts came into being at the 6th month. And the contract modification there is to provide core services through the use of CUG. As you said earlier on, that modification can still be treated as a new contract.
Fantastic, thank you. And it can also be what? Be modified. We can modify the existing contracts, or we can use both options. All right, thank you very much, sir.
We have another hand up.
All right. Okay, please, let's submit ourselves and okay, we have, who is taking the floor, please? Let's unmute ourselves from there so that we can make use of our time effectively.
So you can go ahead. No hand is up.
All right, thank you very much. From our slide, hope my slide is visible.
Yes, please.
All right, thank you. So from my slide here, we have the multiple contracts, as Mr. Oluseji has already said. The first contract pertains to the data service, while the second contract is specifically for voice call service via CUG, while the modification of the contract is the one that exists after 5 months, which is the engagement of CUG for undistracted services. So let's go to the next question. I think that is clear enough, and that is how you are going to apply it in your operations, no matter how complex it is. That is how it has to be applied. So the second question now goes to Julius Berger. JB, that is, Julius Berger, a leading construction company, has entered into a contract with City Development Corporation, CDC, to build a new commercial complex in the heart of the city. Then after 3 months, CDC decided to expand the scope of work by adding a parking garage to the complex, which was eventually agreed by both parties. Number one, what is considered as a contract with customer from this scenario? And number two, what are the multiple contracts and contract modification made from this scenario? So I need someone to answer that too as well. Let's answer that too. No, we have a contract leading a leading construction company that entered into agreement with CDC to build a commercial complex in the heart of city. After 3 months, as CDC decided to expand the scope of work by adding a parking garage to the complex, which was eventually agreed by both parties. So we can assist us with that solution. Okay, Mr. Obi, thank you very much. You can unmute yourself. Christy, please, are you there? Mr. Obi is raising hands.
Meet yourself.
Okay.
It's not working. It's not working.
Okay.
Okay, I won now.
Okay, you
The
are.
contract for the construction of the commercial complex, and secondly, the parking lot that will be added. These are the 2 contracts.
Okay. Thank you very much, sir. So we have the why the contract modification will be the after 3 months they decide to expand the scope of work by adding a parking garage. So as you have said, the initial contract is the construction of commercial banks and the construction of commercial complex, and the modification there is the additional parking garage. Please, let's go ahead. That is how to identify contract with customer. We are using MTN and Julius Berger Construction Company as a case study. So let's go ahead to the second step from the fifth step model of IFRS 15, which is identify performance obligation. As I've said, performance obligation is that promise you made to your clients to deliver excellent goods and services. So the illustration one is ABC Venture enter into a contract with MTN to provide the following services: the voice services, data services, messaging services, and roaming services. Required, identify performance obligation from this scenario. Number two, identify distinct and series of distinct obligation. Who can assist us with that as well? We said we have two types of obligation, which is what? Distinct and series of distinct obligation. So from MTN point of view, what is the performance obligation from this scenario pasted? And also, what is the identify the distinct and the series of distinct obligation? So someone should address it too.
Okay.
So who is assisting us, please? Let someone assist us with that answer so that we can conclude this as soon as possible. Yes, identify performance obligation from the scenario. So what is the performance obligation from this scenario? Okay, Madam Okiki, Madam Kikelongo, please, you can go ahead. Please, you can unmute yourself. Christy, please assist us. Christy, please assist us. Christy, are you there?
Yeah, my internet is unstable.
Okay, Madam Okiki, please, can you unmute yourself? Madam Kikelongo, can you unmute yourself, please?
Let me unmute her.
All right.
Hello, Ma, can you hear me?
Yes, we can hear you.
Okay, for the
All right.
performance obligation there, the performance obligation to MTN is for them to provide the voice call services and the data services to ABC. And once they've been able to do that, for like the last person that answered mentioned, they have been able to successfully deliver that for 5 good months before the coming in of another performance obligation, which is the voice. So what in effect, what we have in here is 2 performance obligation, which is the voice call and the data services to be provided. Thank you.
All right, thank you very much, Ma. You have done justice to that too. So, from MTN point of view, they have we have already identified that performance obligation, which is the rendering of service. Hope you are seeing my slide. We have answer to that question there. Okay. Yes, the performance obligation in this contract is the voice services, the data services, the messaging services, and the roaming services. And when we talk of the distinct performance obligation is also the voice services, the data services, the matter, because they can be used as a standalone service. They can be used as standalone service. And when we talk of the distinct performance obligation, connection of all the services. Connection of all the services together forms what? The series of distinct goods and services. All that is taken to. Voice call, data services can be what? Can be used as a standalone. They can be required for independently, and that makes it a distinct performance obligation. But when we talk of series of distinct performance, connection of all the services makes what? A series of performance obligation. All that is taken. Please, let's go ahead to the next question, which is from Julius Berger, a leading construction company. JB, a leading construction company, has entered into a contract with government to build a new commercial complex, do civil engineering, project management, and maintenance in the heart of the city. Required, identify performance obligation from this scenario. So what is the performance obligation from this scenario? Julius Berger has entered into an agreement to build what? To build a new commercial complex, do civil engineering, project management, and maintenance in the heart of the city. So we need to identify the performance obligation from this scenario and also identify distinct and series of distinct obligation. Please, who will assist us for that? Who will quickly assist us for that so that we can proceed? Okay, let me just, okay, we have a hand already. Okay, Atoyebi, please, you can unmute yourself so that you help us answer the question. Okay.
Please, you have the floor.
Oh.
All right, the distinct performance obligations. Okay, the performance obligations are building a new commercial complex, civil engineering, project management, and maintenance in the heart of the city. And all this can exist on their own, so they can be tagged as distinct,
yes, sir.
Each and every one.
Thank you,
So
sir.
the series is the combination, as you have earlier told us.
Yes, thank you very much, sir. That's just the question. That's the answer to the question. So we have, as it is here, we have the distinct construction of commercial complex, civil engineering. Hope you are still seeing my slide. Civil engineering work, project management, and maintenance. These are considered as distinct services because the government can benefit from each of these separately. And also we have a series that's a collective of all the performance obligation. So let's quickly go ahead. Please. All right. Okay. Let's quickly go ahead. Let's quickly go ahead to the third step model of the fifth model, the fifth step model of IFRS 15, which is determination of the what? The transaction price. From number one scenario, Mike subscribed to a prepaid plan costing 3,000 naira per month, which includes 10 gig of data, 500 minutes of talk time, and 1,000 SMS, 1,000 SMS. Additionally, Mike purchased a router and a switch costing 20,000 naira directly from MTN for office use. Required, identify the transaction price in this scenario. Number two, identify the fixed and variable prices in this scenario. So we can quickly help us with that answer. We can quickly help us. I'm sorry, I pasted some questions, some answers to our chat box. We are going to get there very soon on the allocation of transaction price to performance obligation. Please, who is going to assist us with this? Mike subscribed to a prepaid plan costing 3,000 naira per month, which includes 10 gig of data, 500 minutes of True Talk, and 1,000 SMS. Additionally, Mike purchased a router and a switch costing 20,000 naira directly from MTN for office use. Required, identify the transaction price in this scenario. Number two, identify fixed and variable prices in this scenario. Please, I'm waiting. I want someone to do justice for us. Okay, Madam Kikelo, thank you very much.
Madam, you have the floor.
You. Okay, thank you. Let me try. Okay, for this scenario for Mike, for the cost, the transaction price, we have two transaction price in this scenario. We have that of 3,000. The 3,000 that I bought for the this data. I'm looking at the question. This prepaid plan, 3,000 on monthly basis, although it has other features, the features of 10 gig as data and 500 minutes talk time, which are added at value to him buying that plan. Then he has a cost of 20,000. The 20,000 he purchased for the router and the switch. Those are the transactional prices that featured in this scenario. Then for the question on fixed and variable cost. For fixed and variable cost, the fixed cost in here is the 20,000, because when you talk of the router and the switch, it's a one-off cost. And it's something that is going to be, it has a lifespan, so to say, and at the same time, it will use it from time to time. It does not need to change, because this one does not change, and it does not really need to, aside from maintenance, when it has issue, maybe you develop any technical issue, except that is the fixed cost. But for the variable cost, this instance is the 3,000. Because for you to have a switch and a router, you need for databases to be able to access internet and do all your other Google and features that you want to use data for. You will need to continually purchase 3,000, which is a monthly plan, as it's been said in that scenario. So we have the fixed cost as the 20,000 for the switch and the router, and the 3,000, which is the fixed cost. And I've been able to identify the transactional price in this scenario. Thank you.
Thank you very much, madam. Thank you for the contribution. I really appreciate that. We have another hand, we have two hands up, three. Please, please help us to mute them so that they can contribute. We have Sheffield Ahmed. Please, can you mute yourself and you have the floor? Sorry, Christy, please, are you there? Okay, let me just have the floor because of the time. Mrs. Kikelomo have tried. Yes, from this scenario, or Mr. Ebenezer, can you have the floor? Okay, from this scenario, the fixed cost here is the 3,000 naira per month. And the variable cost here is the 20,000 naira directly from what? The purchase of router and what? And the switch costing 20,000 naira directly from MTN for office use. Reason: 20,000 naira is being affected by what? The market price.
Okay.
Because it varies. Market price always varies. MTN is not the manufacturer of the router. They also purchase it from somewhere to what? To warehouse and sell for their customers. So they don't have control over that price. And that makes it what? Varies. That makes it varies. But when we talk of the data, at some point in time, we have, if you want to purchase data, if it is 3,000 and you see it, it will be a kind of fix. If you click on one, you know you are going to 3,000. If you click on two, you are going to 4,000. So they have control on it. It makes it fixed because it is automatically, and to some extent, it's fixed in nature. But when we talk of purchase of router, MTN is not the manufacturer of the router, but they take it from somewhere to what? To sell to their customer. So the market can change at any time. If I'm not in this era that we have, If you price something today, tomorrow you'll see another thing. And that is the reason why all these sellers, they are having issues. Nobody will give you a fixed price. They'll tell you, madam, please let me come back from the market. And they'll be calling you from the market. Madam, this thing is 10,000 naira. Send your 10,000 naira now. Because if you go back and come tomorrow, it might be 12,000. So MTN does not have control over that 20,000. So that makes it vary. But when we talk of the purchase of the data services, you know, to some extent, it becomes fixed. Hope this explanation is gotten. Hope I'm communicating, please.
Yeah.
All right. Thank you very much. Let's just proceed because of our time. Let's go to the next scenario. The slide will be made available to us for us to see the answers to those questions here. So let's just go to the next question so that we can round up quickly. Julius Berger entered into a contract to construct a highway for a government agency at the price of 100 million. JB also purchased cement and steel for projects costing 20 million and 10 million respectively. Required. Identify the transaction price in the scenario. Number 2, identify the fixed and variable prices in the scenario. So we can assist us with that too. What is the transaction price here? And let's identify the fixed and variable prices, the variable cost, the fixed cost and the variable cost from this scenario. So we can quickly assist us so that we can move on. Please, I need hands so that we can move on. We can assist us. All right, Mr. Atoyebi, please, you can have the floor, please.
Please, you have the floor, Mr. Atoyebi.
All right.
Yeah.
Yeah. When they were entering into contracts with the government, let me say the transaction prices first. The construction of highway, 100 million, and purchase of cement at 20 million, purchase of steel at 10 million. So to identify the fixed and variable prices in this scenario, actually, when they were entering the contract with government, they will now put into consideration inflation rate and all that stuff to determine what will cost them. So for me, the construction of highway comes as a fixed price. So purchase of steel and purchase of cement, they have no control over that as well. Well, become variable. That's how I see it.
All right. Yes. Thank you very much. Thank you very much. That is it. The price there, as we have identified, is what is the 100 million, the 20 million, and the 10 million, which are what the transaction price involved in this scenario. And the fixed price here is what is the 100 million, because before you enter into a contract, there must be an agreement. There is an agreement fully signed before the commencement of the construction. So the fixed cost here is what the 100 million. While the variable cost is what the purchase of cement and the steel, because market can change, as I said in the first scenario. You know, nobody has a control over the market price, so anything can change, and that is the reason why most construction companies now are being careful in price, in quotations, because the price you have today cannot be there tomorrow, and the contract is already fixed at so amounts. So these are the disadvantages, these are the difficulties being faced by most of construction companies. And I was said that I heard from one source that said there's what we call valuation, that revaluation of cost based on the economic value. So I think we are clear with that. Please, let's quickly go ahead with the fourth step model of the fifth step model of recognizing revenue according to Ifrs 15, which is allocate the transaction price to performance obligation. Solomon subscribed for 10 gig of data for 10,000 naira and was given 300 messages and 200 minutes for voice calls required. Allocate the transaction price to performance obligation. I sent something to our chat box. Please, let's open. But I need somebody to attend to this question first before we go ahead to see the solution. Solomon subscribed for 10 gig of data for 10,000 naira and was given a free 100 messages and 200 minutes for voice call required. Allocate transaction price to performance obligation. So who can assist us, please? So we can assist us allocate the transaction price to performance obligation. Now we have usage, not costs. Solomon subscribed to 10 gig for what? For 10,000 and as what? A free 100 messages and what? 200 minutes for voice call. So how are we going to do that for us to be able to be able to allocate that transaction price to performance obligation? Maybe I should just let me go ahead to analyze this. The first thing we need to do under empty-hands operation is to convert the usage to value, because we can't use the usage to allocate for the allocation. First, we convert the expected usage for voice call, SMS, and data to their respective value first. By what? Determine what? Their standalone price, as I've given the scenario. So we first know what are the prices. From this, if you open, please, let's open the solution here. For the voice call, the conversion rate for the voice call is 15 naira per minute. For SMS, it's 10 naira per message. And for data, is 300 naira per gig. And we have, for voice calls, we have 200 naira. We have 200 minutes. So we convert the 200 minutes using what? The standalone price, which is what? 15 naira per minute. That is 15 naira times what? 200 minutes, which gives us 3,000 naira. Hope we are on the same page. Let's open allocation of transaction price to performance obligation. I send it to our chat box. Let's check our chat box and open that. That is where I'm analyzing this scenario from. Hope we are on the same page. Please, I need a feedback. Hope we are on the same page. Christy, hope we are on the same page. Christy, are you there? So I need a response.
I'm here.
Okay, you are there. Fine. Thank you. So, okay, for voice call,
we have somebody hand up. Hello, Toby. Somebody is raising up his hand. It's Toby, you have the floor.
Okay, thank you. Let's listen to that.
Please unmute. Mr. B, you have the floor.
All right.
Okay, Toby, you may wish to continue.
Okay, let's do that. So for voice call, we have 200 minutes. So we are going to discuss, we know now we know the conversion rates, which is 15 naira per minute. So we multiply the 200 minutes times what? 15, we get 3,000 naira as the value. For SMS, we have 100 messages. And the standalone price, which is the conversion rate, is 10 naira per message. So we multiply the 100 minutes, 100 messages times 10. That gives us 1,000 naira. And for data, we are told that data is per gig is 300 naira. So we multiply to get the value of data. We multiply the 300 naira times 10. Then we get 3,000 naira. So in addition, we have the total standalone value of 7,000 naira. We have a total value of what? 7,000 naira. So this is the value we are going to allocate to what? To the performance obligation. So let's try to allocate the transaction price now as the 3,000 naira, a standalone price divided by the total standalone price of 7,000 times the consideration of 10,000, which gives us 4,286 naira. That is for voice call. For SMS, we have 1,000 naira divided by 7,000 naira, which is the total standalone price, times the consideration. That gives us 1,429 naira. And for data, we are able to get 3,000 naira for the standalone price divided by the total standalone times the 10,000 naira consideration. Gives us 4,286 naira. In addition, we come back to our the 10,000 naira. So you can easily see how we allocate the transaction price to performance obligation. Using what? The standalone price. By what? Using the conversion rates. Hope we get that clear. Please, let's continue. Let's continue. Let's continue. The solution will be made. It's already made available. We can go through it when we are less busy. So Julius Baker entered into a contract to construct a highway design and manage the project for a government agency at the price of what? 100 million. Required, allocate the transaction price to performance obligation. From this scenario, contract has already been allocated. Each performance obligation has already been given their transaction price. Because in any contract, there must be approval being gotten. The prices must be attached. So you can see the difference between construction company and a telecommunication company. Telecommunication company, we have to convert before we can recognize. But in construction company, the allocation has already been done initially, even before the commencement of the operation. You can see how company varies in recognizing revenue, and that is how we are going to apply it in your own operations. It depends on what you are doing, and that is why you are going to recognize your revenue. So under Julius Baker Construction Company, all transaction has been what? Directly allocated. Hope you are seeing my slide. You can see contract price already allocated as follows. We have construction company 70 million, design 20 million, project management 10 million, altogether 100 million. So let's quickly go ahead because of our time. Let's look at the last step of the 5th-step model of IFRS 15. On December 20th, 2023, Mike subscribed to a prepaid plan for a month, that is 31 days, ending on January 21st, 2024. That is a month subscription. So data costs 3,000 naira for 10 gig, voice call costs 2,000 naira, and also 100 minutes for voice call with what? With 50 free SMS, which cost what? 200 naira. As of December 31st, no SMS was sent due to network issue. Note, as at 31st of that year, end of the year, no SMS was sent due to network issue. Required, identify the performance obligation and transaction price from this scenario. And number 2, how will MTN recognize its revenue using at points in time and over time. So who can assist us with that before we proceed? I think because of our time, we have, let's quickly open to the recognition of revenue under MCN is in our chat box. Is in our chat box already. Just let's open it together so that we can quickly make use of the time. So from my own end here, how will I recognize revenue according to the standard? At point in time, what are you recognizing for MTN at point in time? The transaction was done as at 20th December 2023. So is there any revenue you are going to recognize? From this, according to IFRS, there is no revenue to be recognized because there is no consumption being done. You can't recognize at point in time because there is no consumption being done. You have not consumed everything. You have not consumed. So at point in time, there is no recognition of revenue. So let's see over time. Let's just go down. We see over time. So let's quickly see how to recognize revenue over time because of our time. So how do we recognize revenue over time? Fine, we first discover what are the performance obligations. We know the performance obligation is the data, the voice call, the SMS, and the transaction price here is the 3,000 naira for data, voice call 2,000 naira, SMS 200 naira. All together, we have 5,200. So how will you determine the transaction price? First, we have to know the data consumed. How are we going to know the data consumed? By what? We have to determine by dividing the cost with the total amounts. We have to recognize revenue as at 31st December, right? And we have 30 days, 31 days. So we go for proration. Let's go to the number of days. If you click on it, you see how it's being prorated. We calculate from 20th of that month to 31st December. That gives us what? 11 days. That is, we are recognized revenue at 11 of what? The 31st days, because that is the only days being consumed. That is the only days we consumed the products, the services. I don't know whether you are getting me. We said we recognize revenue based on consumption. And we are going to recognize this revenue. We are trying to recognize as at 31st December of that year to know how much we are recognizing as revenue. So we base on days of consumption. We have 31 days. And when we count from 20th to 31st, we have 11 days. Hope I'm communicating. So the data consumed per day is being given as what? We divide the 3,000 naira divided by number of days, total number of days, which is 31 days, to get what? Per day. Now depends on the usage of each customer. So per day here is 96.77 kobo for data and 64.52 kobo for voice call. Then we multiply by the number of days to 31st December that year. That is 11 days times what? Per day, which is 96.77 kobo to get what? What to recognize as at 31st December that same year. We do the same for voice call. We have 1,936.48 kobo, and in total we have 3,000 naira. So for SMS, what are we going to recognize as at 31st December? No recognition. We are not going to recognize anything because we were told that there was network issue. So no SMS was sent out as at that particular time. As at 31st December, there is a network issue, so it's assumed no SMS was sent. So as at 31st December, we are not going to recognize anything for SMS. So when you go through the Excel sheets with the link here, you'll be able to get more about it. So how are we going to recognize our revenue? As at 31st December, we will recognize 477.74 naira 19 kobo as at 31st December. Why the other one 3,428 naira 81 kobo will go to what? The contract liability. The contract liability account. You can see how complex this kind of transaction is. Going from the per seconds to usage, conversion, and later allocation of transactions. You can see how complex it is. So that is the reason why most companies have a software for making this more easier. We are still going to get to that. So let's quickly go to the last question here, which is for Julius Berger. Julius Berger entered into a contract to construct a highway for a government agency at the price of 100 million. The contract price is allocated as follows. For construction company, for construction, we have 70 million, design 20 million, project management 10 million. Then in total, we have 100 million. Additional information. For construction, 40% of construction was completed as at 31st of that year. 40% of the construction was completed as at what? That December, as at 31st December of that year. For design and project management, the design work and project management are for what? Are for 2 years duration. Are for what? Are for 2 years duration. So how will Julius Berger recognize revenue? Using it at point in time and over time. Let's quickly open the Excel for recognition of revenue under JB. Yes, I've opened mine. So for construction company, contract price will be what? We allocate 70 million for the contract price. And we were told that the estimated completion is for what? Is for 2 years. And the percentage of completion is what? Is 40%. So as at 31st December of that year, is only 40% we are recognizing under the construction, because that is the only one that was completed. So we said 70 million times 40% gives us 28 million. While the remaining balance of 42 million will be what? Will go into contract liability until the project is being completed. So let's look at for the design also. We are told that the contract price allocation is 20 million. The design work is evenly distributed over 2 years. So we have 20 million divided by 2 years, which will give us 10 million. That is, 10 million will be recognized as at that year. While other 10 million will be credited into contract liability. Same for project management. And at the end of the calculation, the total amount of 43 million naira will be recognized as revenue as at 31st December of that year, while the total of 57 million will be carried forward to the second year. The accounting entry, you debit the cash or bank for the 100 million, then contract liability for what? For the cash received, which is 100 million. Then being amount, then you have to credited what? The 43 million for as at 31st December of that year for the work completion, and debit for contract liability for that 43 million naira. You know, the initial 100 million has been credited to the liability. So when we are now recognizing the revenue, we credit backward the contract liability for 43 million naira. So while the remaining balance of 57 million will be carried over to contract liability until the completion of the contract. So thank you very much. That is the end of the question. So let's quickly go through our slide. I know we have the questions, and I will set the slide after the training so that we can all go through it in our own leisure time. So let's Christy, please confirm. Are you still seeing my slide? Let's conclude, please. I'm sorry for taking your time.
Yes, please. Thank you so much.
Sorry, let me quickly conclude this. We have to talk about the recognition and disclosure. So revenue, I hope you are still seeing my slide over there.
Yes, your slide is showing.
Yeah, thank you. Clarifying the method used to, the first one is, what are you going to disclose? Revenue recognition disclosure. Under revenue recognition, you clarify the method used to recognize the revenue, whether it's at point in time or over time. And how these methods were, and how this method align with what? The accounting standard. Then the timing of the revenue, you explain the revenue recognition, especially if it is at point in time. You will explain it, how it's being gotten. Then the performance obligation too. You talk about the performance obligation to help the stakeholder understand what triggers your revenue. What are your performance obligation? What do you have? What are you selling that triggers that revenue? So you have to disclose that too. Then estimations, the estimation method and assumption. What are the assumptions you use? Provide a transparency about the key estimates and assumptions used in recognizing it, so that when it's a variable consideration, what did you use to measure your variable cost? Is it because you like the customer? You tell them this is what happened, that's why I give this person a discount. So you explain all this in disclosure in what? In your financial statement. Then under the contract modification, you explain how modification to contract with customer are accounted for, and whether they result in what? The changes to revenue recognition. So the software I talked about, software available for recognition of revenue according to Ifrs 15, we have Oracle Review Management Cloud. These are the applications used for complex organization in achieving this standard. I know it will be a little bit costly, and that is one of the constraints when applying the standard. If there is no fund, it's very difficult to abide by the standard. Then we use SAP, revenue accounting and reporting. Then we have weekday revenue management as well. So let's go ahead. So what are the takeaway? What are the takeaway from this training? What are the takeaway from this training? Number one, under Ifrs 15, revenue is recognized when performance obligation is satisfied. Revenue is recognized when performance obligation is satisfied. Number two, any payment received from customer without entity having fulfilled its performance obligation under the contract should be recognized as what? Contract liability in the financial statements. And number three, where performance obligation is satisfied, but the occasion is yet to be received, the entity should recognize revenue with contract receivable under the asset. So, in conclusion, IFRS is not just a regulation to comply with. It is a framework that empowers us to present a clear, accurate, and transparent picture of our financial performance. So thank you all for listening, and thank you all for making yourself available for this presentation. So Christy, you can have the floor. Thank you very much, everyone.
Thank you so much, Toby, for taking off today's IFRS 15 as a whole. I really enjoyed the section, and I want to believe other participants also do. And at this junction, I would like to appreciate everyone that stayed from the beginning to the end. Thank you so much. And I could see some people hands up. I'd like to recognize Mr. Shegun Sulema Balogun for your contribution or your question. Thank you. You have the floor. Please go ahead. You have the floor. Then after him, Mr. Michael Timsitoye should get ready. Mr. Shegun, you can unmute yourself if you can hear me. Please, can you hear me? Okay, Mr.
Hello?
Michael, you can go ahead. Mr. Michael, go ahead with your question.
Hello, good
You have
afternoon.
the floor.
Hello?
Good evening to you.
Yeah. Can you hear me?
Yes, please. Loud and
Okay.
clear.
Yeah, so, okay. Thank you very much for the webinar. The thing is, I did not receive the solution for the questions that she was explaining. The Excel sheet. She mentioned that she sent it to the chat box, but I did not receive it. So that's what I actually want to
Okay.
request for.
May I announce to all the participants that all the materials for this webinar will be sent to our email, our registered email, including the recording, so that we can listen to it at our home convenience. Thank you so much.
Okay,
Can I have the other?
Thank you,
Thank you. Mr. Shegun Suleiman, are you still here? Otherwise, let Mr. Obi have the floor. Mr. Obi, you have the floor, please. Mr. Obi, are you there?
Yes, I am.
Okay, can we have you?
Yeah, I want to thank very immensely Toby for this wonderful work on IFRS 15. She showed a good master of it, and I think if we follow from what she will send us, we'll be able to understand it. I thank her so much for this, and I will be available for another webinar from her or from other people on this platform. Thank you.
All right, thank you for your encouragement. Toby, we are proud of you. Thank you for this section. Do I have any other person that would like to say one or two things before we call it a day? Mr. Shegun Sulaiman, are you still with us? Okay, I think he's not here, but his hand is here. Okay, Mr. Oluwaseun or Miss Oluwaseun, please, you have the floor. Oluwaseun Amulejoye. Okay, thank you.
Thank you, Oluwaseun Amulejoye. I really want to appreciate Mrs. Toby for this webinar, and for me, our expertise really showed in the delivery of this workshop. So I want to say thank you to her, and thanks to all the team too that worked with her in order to ensure the success of this webinar. Thank you so much. I really appreciate being part. And for me, I see that my time is not wasted being here. Thank you so much.
Thank you so much for your kind word, Madam Oluwaseun. Really appreciate. We know that when we call next time, you all be here. Thank you so much. On this note, I would like to bring this session to an end. Hope to see all of us in the nearest future. Thank you so much for your time. Bye for now.
Yes, thank you very much. Please, let me just chip in this, please.
Okay, go ahead.
Thank you very much, my host. We'll be having another section soon, and we are going to communicate that. I think we have our details now. So we communicate that the next sections we're having, and I promise it to be an interesting one too. And we have series of trainings. Some are not free, some are not free. So we have some that are free. So we are going to communicate same to you. So thank you very much for attending, and I really appreciate it. So over to you, my host.
Okay, thank you so much. Like I said earlier, we expect more. Now that we all enjoyed the section, so we expect more. So everybody, thank you, and have a very good week ahead of you. Bye for now.
Thank you very much.
Please, you can head the section if you are here. You must obviously know, of course.